Hi, this is Andy Filipiuk in Toronto for the week of April the 4th. Financial conditions globally continue to tighten at an even greater speed than what we've been seeing previously. I've shown you this week the 2, 5, and 10-year yields on U.S. Treasuries starting at the beginning of this year and as of yesterday, and you can see just how much rates have gone up. I read a report earlier this week by Phoenix Capital that showed that interest rates in the U.S. over the last 6 months have gone up more than they did, or sorry, the 2-year bond yield has gone up more in the last 6 months than from 2012 to 2018, just to highlight how quickly this has happened. I've also included a chart from Ben Rabideau at North Cove Advisors showing the cost of a typical home from last year to this year, taking a 20% down payment, a 5-year mortgage amortized over 30 years. And as you can see from the chart, the monthly cost was $1,700 a year ago. It's now up to $2,800 this year, an increase of 64%. Now, some of that is due to rising housing prices, but a big component of that is the cost of borrowing. So that's a very large move, and it's hard not to see how this puts pressure on housing prices going forward, especially with the energy price increases we've seen. Now, earlier this week, Lael Brainard, who's on the Federal Reserve Board, had stated that we may see the Fed begin to reduce the size of its balance sheet as early as May. Now, the Fed's balance sheet is currently $9 trillion. We started at $800 billion back in 2008. We've gone to $9 trillion. They hope to take $1 trillion over the next year off the balance sheet. And what this means is they will be selling bonds in the market, collecting the cash, and extinguishing it. And as I've used describing this in the past, this is like taking money or water out of the bathtub. So the quantitative easing over the last 12 years helped asset prices go higher. Now they're starting to drain the tub, and $1 trillion over the next 12 months with the rate increases that we're seeing means that financial conditions are tightening quite dramatically. And I think the Fed will keep doing this until inflation slows or they break something. So asset markets are going to be under a lot of pressure as the financial conditions continue to tighten. Thanks for watching.